Hello everyone, welcome and thank you so much for everyone for coming to this particular virtual session. So this is Siddhant Kumarji from ICMR Center for Innovation and Biodesign, that is ICMR CIBioD, and today we would be talking about virtual seminar which is going to be hosted by CIBioD. Now, giving about brief introduction about CIBioD. So our Center for Innovation and Biodesign is an initiative of Indian Council of Medical Research, which is being aimed at promoting research, innovation, and entrepreneurship in Indian healthcare system. And our CIBioD is being located in PGIMR, Chandigarh. Also, we are also working towards making ourselves as unique health innovation hub and startup incubator established by ICMR at a premium medical research institute and hospital of global repute. Now talking about our organization, we are very into different projects. We have developed 26 projects, and in fact more than that. Slowly and gradually, we are moving towards our aim of building something around digital India. So now talking about our today's the presenter, the speaker of our session, Dr. Manu Kumarji. Thank you so much for coming to this virtual seminar and giving a brief about who is Manu Sharma ji and what he does. Is like he is a very he's actually an assistant professor in University Institute of Applied Management Sciences, Punjab University, and he is a PhD in finance from Swiss Management Center University, Switzerland, and has done his MBA from University of Massachusetts, Boston, Massachusetts. Now, also he has worked with ICICI Bank as a manager in SME financing sector and GE Capital International Services USA as assistant manager for Capital Markets Group. And also he has worked with Trudeau and Trudeau Associates as evaluation consultant, investment banking. Now, he works on performing valuations for companies for the purpose of private equity investments as well as for mergers and acquisitions. And he has published extensively in Journal of Private Equity and has even created an asset pricing theory to value venture capital investment. So yes, so I think so. This is a very brief intro about what Dr. Manu Sharma ji is and how he will go on. And today he is about to give us a session, a virtual seminar on this startup and venture capital investments. So I think so I will allow Dr. Manu Sharma ji to take the stage from now. And yes, thanks so much.
Thank you, Sid. Thanks a lot. Ladies and gentlemen, a very good afternoon to all of you. I'll be talking about startups and venture capital investments. Why startups and venture capital investments are related to each other. That the reason is the most of the startups that we have seen across the world, right, be it Europe, Asia, or US, or that most of the successful startups has venture capital backing. That at some point of time, they have some kind of backing from the venture capitalists who invest money in ideas and very early startup companies so as to get exponential returns from them. So we will discuss both of them as I understand that my audience is most of them are from science background. So I've taken into consideration to give you a flair of how startups and venture capitalists work hand in hand to give us companies like Apple, companies like Microsoft, right? Companies like FirstCry, companies like Flipkart, that what these companies were when they started. They started with an investment of less than 1 lakh rupees. And now Apple is $1 trillion valuation company, right? So I would like to now share my, can you let me share my screen so that I can share the PPT and get started?
Sure, sir, you can.
It says host disabled participant screen sharing.
Let me share the screen if possible, if you can allow.
Sure.
So I think so everyone is able to see my screen.
Yes, I can see. So let us move to the slide number 2. Who is a venture capitalist? A venture capitalist is an investor who invests in ideas and early startups by providing equity capital as seed money, Series A, Series B, and Series C funding. So, ladies and gentlemen, question arises that what is equity capital and what is this seed money, Series A, Series B, and Series C funding? Equity capital and debt capital are two different things. Whenever somebody is going to have a startup, there is a capital that you have to raise, and capital can be raised in the form of equity and or debt. Let's say you want to start your own company, right? You go to a bank and you ask them that, can you give me loan of 1 crores? And they will ask, why? Because I have to start my own business and I'm not investing any equity capital into the business. 100% debt company. I guarantee you that there is no company in this world that is 100% debt. Certain level of equity in the form of coming from your friends, family, investors is supposed to be there. That is equity in nature. Now, equity capital is different from debt capital in a way that debt capital has a limited reward. How? You go to a bank, you want to start your own business, you take a loan at 10% interest rate. Your company is just like, let's say, a $1 million company. 3 years down the line, your company is, let's say, now $1 billion company. Can a bank come to you and say that you were a $1 million company, now you're a $1 billion company, you have seen 1,000 times growth. Instead of paying me 10% interest rate, you pay me 80% interest. Why? The bank cannot ask you. That is the nature of the capital. That is the nature of the debt capital, that he can charge you only the interest rate that was prescribed at the time of taking the loan. Whereas equity capital, the rest of the capital after paying off your interest expenses, right? Equity capital, that is a residual income. You pay off your debt capital, you've paid off the loan, and whatever is left, you pay off taxes on it, and whatever is left is net. This is called equity capital, right? So equity capital out of the net income that remains after paying off your interest expense, after paying off your operating expenses, after paying off your taxes, that is net income. It can be very less, it can be very high, right? It depends upon the kind of company. Very highly profitable companies have very high net income. And look, net income can be negative also for companies where we are seeing high growth. High growth means you are investing far more than you are making. That is also one of the ways. You can't always say that the company has a negative income. That means it's a flawed company. It's an unprofitable company. Sometimes the companies are seeing so much growth that they are investing far more than they are making. That is how high growth companies grow, right? So that is the nature of equity capital that is there. I'll give you just one basic example, right? And that in 1993, when SBI issued its IPO, right? Most of us and our parents and our families, we were very young that time, probably. Our parents were investing money in FDs in SBI. And the capital structure of FD was 99% debt and 1% equity. So imagine SBI, let's say, is taking FDs at 10% and lending money at 15% in the market. And 1% is the cost associated with the 1% is the cost associated with lending. So that 4% return that is generated, right, is going to the net income holders. Imagine somebody did an FD in SBI in 1993 worth 1 lakh, right, is 40 lakhs today. But if you would have chosen a different instrument in the same company, that is equity capital, when the capital structure was 99% debt and 1% equity, that means 99% of the funding that SBI is getting was from debt and 1% was from equity. So instead of giving them money in the form of FD, you would have chosen to buy the shares of SBI. As of today, it becomes approximately around 33 crores. Now imagine one instrument that is debt, right? And another instrument, right? Another instrument that is equity. So you chose to invest in FD. 1993, 2021, it becomes 40 lakhs. But if you have chosen to invest in the equity capital of SBI, today, as of today, 1 lakh is approximately around 33 crores. That is the power of equity. exponential growth in highly profitable ventures, right? Can you go to slide 2, Sid? Now, seed money. The next is seed money. What is seed money? Seed money is just like we are plowing the seeds and the plant will grow. So there is an idea. An entrepreneur has a very good idea. I give you an example that my one of my cousins work in Apple, and he was talking to two of his colleagues, and they were talking about self-driven cars. So they were discussing that self-driven cars have some kind of problem, right? And the problem is because of signal, right? So because the signal, sometimes the signal is weak, sometimes the signal is strong. So when the signal is weak, the self-driven car will bump into other cars. So then they talk to each other about something. I will disclose it later on. And they resigned from Apple. Both of them went to a venture capitalist and discussed an idea with him. Within within 2 days, they get 25 crores worth money to build a prototype. In 6 months, they built the prototype, right? And they saw the success of the prototype. Imagine after 6 months, they sold the prototype for $300 million to one of the companies who were. So what happens? Seed money was invested. Instead of using signal, they decided to use light beam. So they shared the idea with the venture capital that light travels so far, there will be no issue of signal, and we will be able to build a successful technology. So just an idea, somebody invested $3 million. Within 6 months, it became $300 million, and they sold the prototype to one of the companies in automotive industry. So that is the power of seed, that you have an idea so powerful that you can attract venture capital funding, right? Series A, Series B, and Series C funding is like there is a startup company that has built a software which can automate the banking industry. I know there is a company called Goals 101. It has worked with banks, and it has developed a software that automates 90%, 95% of the retail banking business. Now, what happens? They have given this software free of cost in the banking industry. Why? Otherwise, nobody will take the software. So some people are not even willing to take it free of cost. You have to go there, make presentations, and make them show that you are into a very good business. The product is very good. It will actually automate the business, and it will actually create returns for the business. Your retail banking business will work with far more efficiency. But now you are not earning even a single rupee. So that means what? You have moved from seed, and now let's say seed, you have developed the product, but now you need money to market, you need money to hire more people, right? And you need money so that you can generate business. So Series A, Series B, and Series C funding is, these are series in which you can, when you are asking for, after seed money, you are asking for more money, is called Series A. When you go for third round of funding, it is called Series B. And when you go for fourth round of funding, it is called Series C. Now, venture capitalists are the highest risk takers in the capital markets. Why? You're investing in ideas, you're investing in startups, which are very early startup companies. It can go bankrupt any day. So they are the highest risk takers in the capital markets. Venture capitalists evaluates an idea startup with an intention whether such idea startups can become unicorns. Unicorn means $1 billion valuation. We call in the capital markets, we call the company has gone unicorn, means it has $1 billion valuation. In a span of 5 to 7 years, and invest only in those startups where there is a possibility of becoming a unicorn. Now you have an idea, and you think you will go to a venture capitalist and ask venture capitalist for a money. But before you go there, you should know something, that the venture capitalist is not looking to invest in businesses where he gets 30, 40, 55, 60% return on annual basis. He is looking for such businesses which are disruptive in nature. We bring in new technologies, right, that change the way markets do business, right? And if he feels it is there, only then venture capitalists will invest. You can't go to a venture capitalist and say 30, 40, 55% return. In FD, you are getting 7% return. You will no. Venture capitalists will not invest in such. I give you an example. Somebody had an idea, right? And he talked to a couple of venture capitalists. They were not interested in ideas. Well, there are many who like ideas. There are many who don't. They rejected his idea. No, it's not possible. And then one of the investors liked his idea and he gave him $2 million. At that time, $1 million was for 50 rupees. So 10 crores of rupees was given to him. Within 2 years, They changed the way certain people do business, and certain people started doing business in US market. And the valuation of the company changed from that $2 million to $2 billion. So 10 crores became 10,000 crores in 2 years. And the name of the company was eBay. Most of you have heard of it, eBay, where people sell the products to each other. Became a $2 billion valuation company in just 2 years. So this is the nature that they think they are the highest risk takers. They evaluate the companies only in terms of whether there is a even slight possibility of company going and hitting a unicorn in 5 to 7 years. Now, venture capitalists not only invests, they don't not only invest capital. It's not just like you are an entrepreneur, you go to a venture capitalist and he will simply plain vanilla invest in your business. He is someone who's going to contribute to day-to-day operations of your business. He's going to sit on your board, and then he's going to work on long-term goals of the business. Sid, can you please go to the slide number 2? So day-to-day operations of the business. Now, venture capitalist guides the entrepreneurs and uses his or her network to acquire business revenue for the startups. Let's say somebody's in the medtech industry and somebody has developed a machine that can analyze the complete genome of a human being with 99.9% accuracy. Now you are the first one to build this machine, right? What will you do after that? If there is a venture capitalist with you, generally venture capitalists, later on we will see there are industry-driven venture capitalists also. In medtech industry, there is called Orbit Ventures. They have invested around 2 lakh crores in various startups and later on companies in the form of seed money, Series A, Series B, Series C, and private equity funding also, in strictly in biotech and medtech industry. Strictly, they focus on particular industry only, right? So they not only contribute, invest money, but they sit on your board, they guide you, they provide you guidance, and they use their network to bring in business for you. You have developed the machine that can do the genome mapping. Well, they will make sure there are at least 100 people willing to buy your machine, and they can exponentially grow your business. Generally, a venture capital fund, venture capitalist in a fund, right, holds 10 to 12 companies in a portfolio. They don't invest in like 20, 30 different companies. They invest in not more than 10 to 12 companies. The success rate of venture capital funds is not more than 40%. It is approximately 40. For some companies, it is 30, but the average comes out to be 40%. That means if we are talking about 10 businesses, a company's in venture capital fund is investing in 10 companies, that means around not more than 4 will be successful. But the successful startups give exponential returns. The returns are so high in these startups that they not only compensate for the losses in other investments, but also provides so much return that in the 150 years of history of venture capital industry, not even a single venture capital fund has been closed down because of losses. That is the nature of venture capital industry. With just less than 40% success rate, their 1 or 2 companies give them exponential returns in such a manner that it pays off for the losses of other companies, right? Okay, so next slide. Now, venture capital industry. What is venture capital industry? The characteristics of venture capital industry. Venture capital industry is governed by three factors, 3 variables. First is liquidity, second is information asymmetry, and third is cyclicality. Now, it is illiquid. Let's say I want to start up my own company, a medtech company. I'm going to build a new technology, new machine that can, that is an ultrasound machine and it can do wonders. Now I ask 4 of you guys to invest 1 crore each in my company, and let's say you have invested. So there's a 5 crore equity capital in my company, and now one of you now needs money. It is not a stock trading in the market that you will simply go click sell and you can sell it. What you will do, you will go in the industry, in the market, talk to a few people and try to find an investor who can actually buy this investment from you and be a partner in this company. So it can take 6 months, it can take 3 months, and sometimes you won't be able to find anyone who is willing to buy your investment. So it is highly illiquid in nature. Next is information asymmetry. There is an information in, so you are let's say biology background and you are working on building your own technology, but you don't understand the valuation, right? So I say your company is an idea and I'm going to invest money based on an idea. And this idea is just worth 10 crores. How do you know it is worth 10 crores? Why the idea is not worth 100 crores or 50 crores? So there is an information in asymmetry. Entrepreneurs don't know as much finance as the venture capitalists know. And even in venture capital industry also, when one venture capital fund is choosing to invest and other is also choosing to invest, right? What happens? Some venture capitalists understand certain technologies better than the others. That is why all the venture capitalists, venture capital funds, firms don't provide the same return. Some are providing very high return, some are providing mediocre returns, right? So why? Because there is information asymmetry. I give you an example. One of my friends, who's a big venture capitalist, was in depression for good 6 months. He was in California when he heard a pitch of one of the companies pitch say that there is a company as a startup and he's pitching to the private equity investors that they should invest in his company. So he heard the pitch and he was the first one to reject the company. No, 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 no. Nobody is going to invest in such business. People won't come on your website and will pay and use your platform. I don't think so. Well, 21 equity investors, venture capitalists rejected the deal. And 22nd, because of information asymmetry, he said, "No, there is a potential." He invested. And within 3 years, his money became 1,000 times. And the name of the company was LinkedIn. And my friend, when he realized that he was the first one to hear the pitch, and he thought that this company is not going to work out, what happened? He remained in depression for good 6 months that I was the first one who was given an opportunity and I thought this is not going to work out. Well, some people think it is going to work out. Some people think it is not going to work out. So there is an information asymmetry that will always remain. Third is cyclicality. Cyclicality, you see that markets go up, markets go down, right? There are certain sometimes good economic conditions and sometimes bad economic conditions. When a venture capital fund is starting in a bad economic times, that means there is lesser money capital in the market. So what happens? They can claim on lower valuation and put less amount of money and take higher stake from the entrepreneur. Look, there is bad time, and for entrepreneur, it is very difficult to get money. So he will say, okay, for 10 crore valuation, venture capitalists can say, I'll take 70% share. But there are good times in the economy. Economy is booming. For the same investment, it can happen that the venture capitalist can die, give me 40% at 20 crore valuation instead of 10 crore. Why? Because markets move up and down. That is the way they go up and go like trough and crust, but linearly, they don't go up like linearly. Our index was our Sensex was at 100, 1980. Now it is at 40,000. It has grown 400 times up, but it has not grown linearly. It has grown up like troughs and crusts going up and down. So there is an entry point and there is an exit. So those venture capitalists who know when to enter and when to exit make the maximum money out of it. So this is venture capital industry. Next slide. All right, ladies and gentlemen, next is fund structure. Now, how does the venture capital industry works? The venture capitalists are getting money from limited partners. So venture capitalists are investing their own money also, but majority of the chunk is coming from limited partners, and limited partners are institutional investors, banks, pension funds, provident fund managers, right? So these are the companies that are limited partners that you can see. They hire a management company. They tell the management, give the instructions that what kind of venture fund and what kind of private venture capitalists they are looking for who can manage their money. So management company is identifying the general partners. The general partners in this context fund structure is venture capitalists. Now, venture capitalists are investing their money also and limited partners' money also in portfolio companies and getting returns from there and providing back to the limited partners, right? So they are charging their management fees and some percentage of the profit. And then they are giving money back to the limited partners by making money out of portfolio companies. Now, how they make money out of portfolio companies, next we will discuss this. Now, nature of the venture capital funds first. There are three kinds: the stage focused funds, the geographic focused funds, and sector focused funds. Now, you can see that there are many funds. By stage, I mean there are certain funds we discussed here that there is seed money, there is Series A, Series B, and Series C. There are certain funds who say we are going to invest only in seed, ideas and Series A. Certain says we are going to invest only in Series C and Series B. So depending upon that, some venture capitalists are comfortable investing in ideas, where others are comfortable establishing companies which are relatively, though they are early startups, but are they relatively settled, that they have gone to 2 rounds of funding, they have established certain level of establishment is there in the business, and they invest in certain kind of companies. Geographic focused funds, that certain companies are investing only in Asia, they are investing only in China. Some companies are investing in India only. Some choose to invest in Canadian markets, and some choose to invest in US markets. Then are sector focused funds. Sector focused funds are, some companies say, okay, we are going to invest only in software. Some companies say only we are going to invest in only chemicals. Just like I gave you an example of Orbit. Orbit is going to invest only in biotech and medtech companies, not any other company, no matter how good the deal is. They have clearly defined that they are all their investments, which is worth 2 lakh crores as of today. They are going to invest all of it in biotech, medtech industry, nothing else. Now, when the venture capitalist is looking for a startup, right? As I told you earlier, we have discussed earlier that venture capital does hand holding. Venture capitalist does hand holding to the entrepreneurship by providing in his network, right? They are people. They are a team of experienced businessmen, right, who understand the ins and outs of running the business. So entrepreneur knows the technology, they know the ins and out of the business. Together they work hard together and build the products, and then venture capitalists held their hands while getting them business from the market. Now, in startups, with the deal still in infant stage, this is an idea and there is no financial data available, there's no balance sheet, there's no financial statement, you don't know profit or loss. So eBay is just an idea that you will build the platform, people will come and buy and sell from each other. Or LinkedIn will be a platform where people will make profiles, HR companies will pay you to identify the profiles, and eventually the recruitment will happen from there. This is just an idea. There is no financial data available. I'm going to build a machine that I know with my past experience that can map whole of the human genome. But this is just an idea, and there is no financial data to back it up. The lower down we go into the deal, and it becomes more complex to value it. The more subjectivity the criterion becomes. In early stage deals, it is a lot about subjectivity, right? It is the subjective, but still need to put a quantified numbers to it. The criteria in early stage tends to less about company financials. There's nothing like company financials here. So in early stage businesses, when the deal evaluation is happening, now what's happening about what is the venture capitalist looking for in a startup? It's more about, not less about the financials and more about the product, the kind of product, the people running the business, promoters, what is their background, past experience related to the business, the market reputation of the promoters. The other part of the deal is to, I just give you an example. 3 of my friends wanted to start their own business, fintech company in India. Just like medtech, use of technology in medical field is called medtech. Use of technology in banking industry is called fintech. So they asked for a license from RBI, and one of the guys was linked to certain fraud that has happened in Yes Bank. So they didn't get the license because one of the partners didn't have that kind of reputation that they get the license from the investors, like license from the RBI. So they had to shunt him out and bring in the new promoter who has a better reputation than him, and that's how they got their license from RBI. The other part of the deal is to how attractive is the industry. For example, companies in steel industry cannot generate enormous margins. Industries and companies excel, drives the margin, cannot change it. So industry plays a crucial role in the selection of an investment. The venture capitalists choose to invest in an industry where enormous margins can be created and where ROIC can be huge, that the return on the capital that you have invested is huge. So they're not investing in companies which have already industries which have already saturated, right? There are new industries that are coming in as we are moving from medicines to stem cells, as we are moving from pathological tests to genetic tests. So you will see that there is a company in India called MedGenome. The way they are running the business in India and they are running the tests, HDFC Bank has an arm called private equity, HDFC Private Equity. They gave them 150 crore worth funding to establish a bigger network in India. So somebody's evaluating that there is a huge growth, 130 crore population, and we need more and more genetic based tests. And this company has the potential. So they started the product, they started the team, they started the industry and invested accordingly. Also, the industry that requires lesser capital investment to build products that can generate exponential returns. So they don't want to stress themselves by investing huge amount of money and then making losses out of it. So they are looking for those industries where the investment is reasonable and decent in nature. That if you say, I'm going to do the map genome, but I need 1,000 crores for that, it is very hard for you to recover that kind of money in the market. So there won't be any venture capitalist who's going to put so much in capex. The venture capitalists work on expanding the business without focusing on profitability, as research shows that once the scale becomes too big, it is easier to generate profitability now. This line is the research study of Harvard that you keep on venture capitalists. What they do is series A, B, C, then you go to a private equity investor and he will fund your business. You continue to grow your business. That once the business becomes so big that it is almost impossible to fail. So you are extending your business to a level that you are not focusing on whether the revenue is generating profits or it is just generating the revenue for you and is becoming too big, right? Just like Zomato, it was always in losses, but it became $1 billion business. And it became so big that eventually it started earning and profitability for its investors. Now, what does a venture capitalist look for a startup? And even if you are going to open up your startup, then you should look at the same in your startup as well. That is how you're going to get success out of your startup. There are 3 factors that contribute to the success of the startup. The first one is product, the second one is team, and the third one is industry. Now, when the venture capitalist wants to come into the industry, as I told you, seed money, Series A, Series B, and Series C. So venture capitalist wants to see that how much money the entrepreneur has invested, his money it has invested. Why? If I'm not investing even a single dollar of my money, it is venture capitalist money. What happens? What we tend to do when somebody else is investing and we are not investing, it's a human behavior. So when your own money is at stake, right? If your own money is at stake, what happens then? Right? If your own money is at stake, what happens then? Then you start taking things very seriously, right? Then you start taking things very seriously. So ladies and gentlemen, now product, the nature of the product. What is the product, right? What does the product do? I am building a new product, just like I told you, that is going to change the way the tests are done in the medical industry. It is going to be a revolutionary in pathological in a pathological industry, right? So I built a new machine, right? Siemens has built it, or GE Medical Devices have built it. So this is my product. So I built the product that is going to change the way the businesses are done in the industry. Just like I gave you an example of in India, nobody realized the potential of selling kids' garments online. First Cry. Almost all mothers have become dependent upon First Cry for 90% of the products that they buy for your kids, including my wife, right? So their product was a platform, right? Their product was a platform. They gave a platform to the sellers so that they can sell it to the buyers. And what we have seen, do you know there is a data that 40% of the small shops selling garments of kids have shut down in India because there is only one reason to explain it to, in First Cry. And within 3 years, First Cry has become a unicorn. In the times of pandemic in 2020, when market opened up in July and they were allowed to sell couriers online, that is the time when First Cry started selling so many products online that they eventually became a $1 billion business before 31st March 2021. So now you can realize the potential of this 130 crore people economy, that even in the times of COVID, a company became a $1 billion business. Next is team, right? Next is team. Now, when you're going to evaluate your own team, You're building, it's not that you just join hands with your friends and you start working on it and eventually realize. Team means the people have the right kind of experience. The people have right kind of experience to build the product. Those are your friends when you're running your startup. If they don't have the right kind of background and the experience to build the products, and you're bringing in freshers, or you think that you have a reliable partner you can rely on, no, that is not going to build your product. Whether the team has the potential to build the product, to sell it in the market, though venture capital is going to help him. Now, there is one more thing here. Most of the venture capitalists, one of the venture capitalists told me a story that he got a pitch from one of the entrepreneurs about a very good product, right? A very good product in the technology business it was an insurance product. So he invested in it. He invested in the company, and after 6 months, the entrepreneur committed suicide. There were some issues with the wife, and he committed suicide. And he was the single owner, proprietor of the business. Now, where will the venture capitalist go? He's going to hire a few people, then look into it. What was the code and what was the technology and what exactly he did? Venture capitalist is an investor. He has a fair idea about the technology, but he cannot build the technology, replace the entrepreneur in building the technology. So when they are looking at a team, they are looking at investors, at least 3 to 4 members in a team who have invested their own money. They have the right background to build the product, right? Though we have seen only 40% success rate in all the investments done in startups, though this is what is the criteria for them, and they can build the product and they can sell it in the market, right? Some of them, venture capitalists, even evaluate that, okay, they can also contribute to selling the products in the market. That is very good. Third is industry, just like I told you. Now, I give you an example that there are 2 kinds of cancer, right? I'll write it in the chat window if I can. There is a chat window. So there are 2 kinds of cancer, right? The first one, cancer A, has 2 crore patients and a growth rate of 20%. And cancer B, right? Cancer B has 2 lakh patients and a growth rate of 10%. Which one do you think you will build the drug for? Cancer A or cancer B? Cancer A has 2 crore patients and 20% growth rate. And cancer B has 2 lakh patients and just 10% growth rate. Of course, cancer A. Why? Because there are 2 crore patients already there that are your clients, and there is a growth rate of 20%. So you are going to look at those industries where there is high growth, or industries which are going to replace previous industries, right? The industries which are going to replace previous industries. Look, Nokia was a market leader till 2008, 2009, and everybody used to buy more Nokia phone. And their investors were very happy that, what is happening there is their investors were very happy. They're getting year-on-year return. People are happy. They are getting year-on-year their upgrades on cell phone. Suddenly, Apple came up with a smartphone. It was a totally different product built by a team of geniuses in an industry that is $1 billion industry. And there was something called iPhone. People saw something like this for the first time, and they were willing to pay more than $1,000 to buy this. Now, they are in an industry. They built the product. They had the right team. They have a new division which is going to build. They were into MacBooks. They were into laptops. They were into desktops. They moved from that particular business to build an iPhone phone, from a totally different business of laptops and desktops to phones. So they chose the product. They built the product, which was far better and was the smartphone. They had the right team to build it, and they got into an industry where there's an enormous potential. And by the time Nokia invested the money and came up with a smartphone, Nokia was nothing. Apple has already captured more than 40%, although it is more than 40%, but it's billions of dollars, right? So this was the deal evaluation of a startup, that there are these 3 factors that play the most crucial role in determining the success of the startup. Now, investment process in a portfolio company. How does the venture capitalist, this process works? If you are a startup, you will write your business plan. What is your product? What is the market for your product? Why your product can replace something that is already there in the market, right? Correct? Then what happens? A marketing plan you have. Then there is a meeting between the company and the venture capitalists. Venture capitalist will carry out your due diligence. You have done any frauds in the past, you have the right kind of experience, where you worked, what exactly you did, whether you have done any startups before, how successful those startups were, and then the concluding term sheet, which is like when a venture capitalist invests, how much money he invests, and what exactly is the market, what is the total share he's going to get it. Let's say the valuation of business came out to be 10 crore. So venture capitalist says, I will invest 4 crores and I get 40% share. So this is their term sheet. Next is venture capitalist has invested in your startup, but how is going to realize the profit? There are 4 ways venture capitalists realize the profits in startups. First is the company has become too big. Now they are offering initial public offering, right? Initial public offering is going to, what is initial public offering? The stock is listed on the exchange and you can buy it in the market. So they sell their share, right? And they get out. Second is mergers and acquisition. They sell off the business to somebody else. Just like my friend has a company, right? And it's an application software company for the banking industry, right? And it automates 95% of the retail banking business. And Infosys, an undisclosed amount they have offered to this business so that they can buy it from them, right? So his venture capitalist is more than keen to sell it to Infosys. Third is selling shares. You sell it to another private equity investor if you are able to find it. Fourth one is the management buys it out from you. I'm the management, you are the venture capitalist. You say, my share is worth 400 crores now. Well, I take it from my own money, or I take the loan from the bank and I bring in the management pools in the money and buy it back from the venture capitalists. This is what happened in Cafe Coffee Day. The fourth part, management buyout. Why? There was no initial public offering was already there. Mergers, there was enough debt in the company. So the company was unable to create that kind of money so that they can buy it from the management. The other 3 options went out. So the venture capitalist started pushing on the CEO of the company to do a management buyout, that you take loan from somewhere or you bring in the new investor and you buy the business from me so that I can get out. And he was unable to do the management buyout. This is my book on venture capital investments. This is the USA edition. If somebody is more than in knowing more about venture capitalists, we have written the first textbooks. All the venture cap books written on venture capital are more of stories about what has happened in different companies. But we have written the first textbook that can actually be inculcated. Why? Because most of the universities are not teaching venture capitalists as a subject. It is just part of some other subject. So I, along with the Honorable Vice Chancellor of Punjab University, we wrote this book on venture capital investments. It's the USA edition. You can buy it from Sage Publications, was the publisher of our book. It talks about all the things from venture capital, from startup evaluation, venture capital valuation, fund structure, fund economy. It talks about everything. So, ladies and gentlemen, thank you. And if you have any questions, you can ask or you can type them in the chat window. Said you can take questions from them.
So, yeah, hello everyone. I think so. It was a very healthy discussion given by Dr. Manu Kumarji, and I will request the participants to give like more and more questions, and if any queries, if anything, whatever you have in your mind, you can ask right now, and you can ask it via adding that in the chat section. So I think so. We should. Shall we start answering some questions, sir? Dr. Manusha, if you can allow.
If you have any questions, please let me know.
Ji, Dr. Manu. Now, am I audible?
Yes, sir. We can hear you.
Ji.
So there was a disruption because somebody else became, sir, I think by mistake, there was 2 ICMR.
Yeah.
So instead of Sid, you became the host.
Yeah, I became the host. That's why. Yeah. So I think the questions, participants, if you have the question, you can type in the chat window. Okay. So Dr. Manu, if there will be more questions, what we will be doing, we will be collating all the questions and sending it to you via email.
Sure, sir. Sure.
And thereafter, we will be sharing those answers with the participants.
Okay. Sure.
Yeah.
Sir.
And I would like to take this opportunity to say thanks from ICMR CIBioD as well as from the participants on the participants' behalf for such a wonderful interaction. And I hope that this lecture will set the tone for the participants to become the future entrepreneurs. Thank you, Dr. Manu, and we would also, we would also be happy if some of these students will come forward to set up their startups and you as a mentor to them.
Sure, sir. Sure, definitely.
Thank you very much. Yeah, thank you, Dr. Manu.